Are you ready to revolutionize your relationship with money? Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Before we get started, I want to take a moment to thank our sponsor, Set for Life. This show is sponsored by Set for Life Insurance, the ultimate client experience in the insurance industry. Are you looking for the perfect insurance coverage that suits your needs? Founded in 1993 by President Jamie K. Fleischner, Set for Life Insurance specializes in individual life, disability, and long-term care insurance. As brokers, they represent numerous companies in the industry, ensuring that their clients get the best products at the most cost-effective rate. What sets Set for Life Insurance apart? You'll enjoy special discounts, priority underwriting handling, and even exceptions in the underwriting process. So why wait? Contact Set for Life Insurance today and let them be your insurance partner for life. Visit their website at www.setforlifeinsurance.com or call them toll-free at 1-888-553-3559. Today, we'll be really getting into the 8 baby steps for physicians that will help you get your financial house in order. The first baby step is to protect. I learned the importance of this step the hard way. When I was a young girl in India, both my parents worked very hard to make a better life for me and my sister. My papa was a very driven man. He was a pharmacist by training, and he opened his own pharmacy and a pharmaceutical testing facility. My mom would teach chemistry at my school in the daytime hours and then go help my dad in the lab or at the pharmacy in the evening. I lived a happy life, mostly cared for by my grandparents, but I didn't mind that, and a nanny in the bustling town of Indore. Unfortunately, my papa also struggled with mental illness. After many years of hard work, he was offered a high-level position in a large pharmaceutical company, and he thought everything was settled. Unfortunately, he lost the job at the very last minute, and this disappointment sent him spiraling down, and he took his own life at the young age of 35. With the passing of my father, my whole life changed. There was very little life insurance and little to no savings. The businesses were sold or given away to family members. My mother decided to get a fresh start and move us all to the United States. We got here with some suitcases and about $2,000 to our name. Clear on the other side of the planet, away from everything and everyone that I knew, we started over with the help of some family members. It was a tough life, on subsidized lunches, in low-income housing, wearing secondhand clothes, and moving often. This experience really lit the fire under me to pursue financial wellness and protect my family from having to go through a similar experience, should anything happen to me. Whether it is mental or physical illness, or simply an accident, I can attest that life is unpredictable. So the first thing we all should do is extend an umbrella of protection over our loved ones before we do anything else. It's easy to get caught up in wealth building, but I think the first step in any wealth building should be to acquire appropriate insurances and make an estate plan. Life insurance is critical if we do have someone depending on us. We all should have enough life insurance to ensure a stable future for our spouse and children in case of our demise. How much coverage do you need? The amount should be enough to provide an instant retirement nest egg for your spouse, pay off the mortgage and other debts, and cover some, if not all, of the kids' college expenses. The retirement nest egg is calculated by multiplying the family's yearly expenses by 25. More on this later. For most physician families, the life insurance amount should be somewhere between $1 to $5 million. For example, a physician family with 2 kids spending $100,000 a year and no retirement savings would need $2.5 million for the retirement nest egg, plus $350,000 to pay off the mortgage, and say $150,000 for each child's college, which equals $3.1 million. Of course, you would modify that to fit your own family's situation. When looking into life insurance, you'll run across a couple of types of insurance. The most common types are term life insurance and whole life insurance. Whole life insurance is the wrong answer in almost all cases. A whole life insurance policy promises a way to pay for insurance and invest at the same time. But the problem with it is that it offers life insurance for a whole life, which is really not needed. At some point, we'll have enough savings and investments to self-insure. Also, the premiums are very high, and the product is usually front-loaded with fees and commissions, and the returns are dismal. Really, you could be investing this money on your own and getting a much better return. The returns on these insurance policies and the investments in them are even negative for the first few years because of the high fees. What's more, at the time of death, the beneficiaries only get the death benefit promised, even if the cash value of the insurance, which may have grown through investment returns, exceeds the death benefit. So you don't get all your money back, even if you do invest it. Term life insurance, on the other hand, provides an insurance payout of a certain amount of money for a specific period of time. Like I said, we won't always need life insurance. At some point, we'll have enough savings to have enough for retirement and to pay off our mortgage and to pay for our kids' college. So we don't need it for our whole life. Term life insurance is usually sold in 10, 20, or 30-year policy terms. The cost of term life insurance is much lower than whole life, and it can be laddered to provide adequate coverage. For example, a physician early in her career will require more coverage as she will have more debts and less savings. As time passes, she will need less and less insurance as her debts get paid down and her assets add up. So she can have a 30-year policy and a 20-year policy and a 10-year policy at the same time early in her career. And at some point, that 10-year policy will drop off, but she'll have enough savings to make up for that amount. And so on until the 20-year policy drops off, and then she'll have the 30-year policy left. Thus, term life insurance can serve us well. The earlier we buy life insurance, the better, since we accumulate diagnoses as time goes on. That's natural. But unfortunately, these policies do raise your rates if you have a lot of past medical issues and sometimes don't even insure you. So it's important to get it early on in life. So keep in mind that most policies have a 2-year exclusionary period for suicide. That was important in my family's case. So while we're on this really morbid topic, let's also make sure our heirs can get the assets in our name transferred to their names without having to go through the long and expensive process of probate court. We do this by enlisting an attorney to draft a will. That's a document that defines who will take care of our children and who will take over our assets when we die. Wills also generally establish trusts that pass assets to heirs without probate court. It's also very important to go ahead and designate beneficiaries in all of our retirement and investment accounts, so you can do that outside of a will, and that makes the process even simpler for your heirs. As your assets grow, you can get into more complicated estate planning strategies such as irrevocable trusts for estate planning, which get assets out of your name and into the name of a trust even while you're alive. Finally, we're healthcare providers, so we know how important it is to have an advance directive and a healthcare proxy designated in case we can't make decisions on our own. No, advance directives aren't just for the elderly. Any one of us could get in a terrible accident or get stuck on life support. Now is the time to write down your wishes and put those limitations on interventions if that's what you want. Remember, advance directives are if-then documents. If I'm in a vegetative, irreversible state, then take me off of life support after giving me a chance for X amount of months, for example. A MOLST, on the other hand, or a DNR status, is effective right now. In New York State, it's called MOLST, or Medical Orders for Life-Sustaining Treatment. In other states, it might be called something slightly different. But the gist is basically that this document defines what you would like EMS to do right now in case your heart stops. So would you like to be resuscitated or not? These are not if-then situations. This is now situation. Right, so now we've got our estate planning in place. Now let's come back to insurance, because there's another essential category that we need to talk about, and that's disability insurance. There are 2 types of disability insurances, short and long term. A lot of young doctors get some of these insurances from their employers and they think they're covered, but unfortunately the ones that come from the employer are not that great. We invest a lot of time and money to acquire our knowledge and skills as physicians. And we can accumulate a lot of wealth, but a lot of our wealth is actually, when we first graduate, it's all in the future, right? We just have that earning potential because of all that knowledge in our brains and those skills in our hands. But unfortunately, an injury can inhibit us from earning that future income. So that's when long-term disability insurance comes in. If an injury or accident inhibits your ability to practice medicine, your long-term disability insurance is supposed to protect you from losing your income and protect your family from having to completely and drastically change their lives. However, most employer-sponsored policies only cover for total and catastrophic disability. That is disability that prevents us from working in any field at all. For example, if you were an interventional cardiologist that couldn't cath anymore because of a tremor, your long-term disability policy would not kick in most likely because they would say you could still work as general cardiology faculty, even though you would be taking a good pay cut. An own occupation disability policy, in contrast, would cover this cardiologist if she couldn't cath anymore and had to take a significant pay cut. That's the difference between own occupation and other definitions of disability. The employer-sponsored policies usually don't have an own occupation definition of disability. It's really important that you take a look at this now and see if you do truly have an own occupation policy. You probably don't. Most of these own occupation policies are individually purchased, and that's good because since you're paying the premiums, you don't have to pay taxes on the disability benefit if you ever should require it. So if you did get the payout from your employer-sponsored disability policy, you would have to pay taxes on that because you're not paying the premiums. Like life insurance, disability insurance is cheapest if it's bought early in our careers prior to pregnancy, so we don't accumulate a long list of past medical history, hopefully. So we were just talking about long-term disability insurance that kicks in after 90 days of not being able to work. There's also another category called short-term disability insurance, which kicks in if you're disabled for less than 90 days. This is an important purchase for people anticipating being out on maternity or paternity leave, or those that don't have a 90-day emergency fund yet. So basically, doctors early on in their careers. Most employers offer short-term disability policies, and these are usually fine. Look into these closely if you're planning on starting a family or you may need to take a medical leave soon. Of course, let's not forget about health, dental, and vision insurance, as we're talking about health problems. Health insurance comes in many different flavors. Here's some of the options. There's the PPO, which is the preferred provider option. This is the typical healthcare most people used to have in days past when insurance actually covered stuff. But basically, a PPO is a contract between insurance contractors and a list of doctors and hospitals to offer discounted rates on services. Annual out-of-pocket costs are usually lower and the premiums are usually higher than other options. Most employers are now offering high-deductible plans. High-deductible plans offer lower premiums, usually in exchange for higher out-of-pocket costs. This is not always the case, so make sure you look at the numbers. But this is the general trend. In 2022, annual out-of-pocket maximums were as high as $14,100 for a family. To help offset those out-of-pocket costs, participants in high-deductible plans are usually offered access to specialized health savings accounts that are tax-advantaged. The FIRE community, or the Financial Independence Retire Early community, loves HSAs. HSAs, or health savings accounts, are triple tax protected. That means the contributions are not taxed, the contributions grow tax-free, and then the withdrawals are not taxed as long as they're used for healthcare expenses. And the contributions and the investments can roll over year on year, so you don't have to use them, and you can kind of use it as an extra retirement account. So this can be a very powerful account to pay for out-of-pocket costs for healthcare if you need it, or to save for retirement. Some employers even contribute a set amount for their employees to their HSA for them. Another account for saving for healthcare costs is the FSA, a healthcare flexible spending account. Is not as advantageous as an HSA because they have lower contribution limits and usually cannot be rolled over to the next year in full, but they can help save for out-of-pocket costs. HRAs are another type of account that help offset some of the out-of-pocket costs of healthcare. Health reimbursement arrangements are employer-funded plans that reimburse employees for out-of-pocket costs tax-free. However, unlike HSAs, they are not portable and remain with the employer if the employee leaves. An HSA is your own and you can take that with you. So let's continue on with the types of health insurance plans. Another type is a health maintenance organization, which is an HMO. HMOs offer a small selection of doctors as they're employed by the insurer. Another type is an EPO, or exclusive provider organization, that are like PPOs but offer coverage only when seeing in-network providers. So there are a lot of different options. Make sure you pay attention to the out-of-pocket costs. Unfortunately, cost sharing is a standard across the industry now. Here's some things to keep in mind. A deductible is the amount the insured, or you, must pay before the insurance really starts kicking in. A copay is a fixed amount that you need to pay to your doctor's office per visit. A coinsurance is the percentage you must pay even after you've met your deductible, until you reach your out-of-pocket maximum. So that out-of-pocket maximum is an important number because you'll probably get to it if you have a lot of healthcare expenses. That amount is the amount after which the insurance actually covers all the remaining costs of your healthcare in full for the year. Whew, that's a lot of details. Now that you kind of know the general gist of insurances, you might, if you are self-employed, need to buy your own health insurance on the marketplace. The federal marketplace lists insurances in metal categories. The categories go from bronze, silver, gold to platinum. Basically, as you go from bronze to platinum, you get higher premiums and lower out-of-pocket costs, and vice versa the other way. All right, so that's health insurance. Thank God we're done with that. Next, vision and dental insurance. If you're employed, you'll probably get this from your employer. Remember that they generally only cover preventative health and offer discounts on problem-related services, so they're much different than health insurance. Finally, another type of insurance doctors need is malpractice insurance. Most employers will provide it for employed workers. If you are not employed and have your own practice, then you're going to need to buy it on your own. Additionally, some doctors also purchase umbrella insurance to cover them if someone sues them above policy limits, or if they have rental properties, or say they have a pool and someone gets hurt in their pool, they have umbrella insurance to cover for whatever home insurance won't cover for. So we've done a lot of protecting already. The final layer of protection is protecting your marriage. A wise man once said to me, when entering into any contract, figure out how it ends before it begins. So if you're not married yet, consider drafting a prenup. Or at least have a conversation about it before you even start. Because what this does is it defines what happens to your family's assets in time of a divorce. We know that a lot of marriages end in divorce. And this is an eventuality we really need to face because it can be detrimental to everyone if this is not done correctly. It is a really big hit to your wealth building ability if you get divorced. And also it's a huge thing that sits on your mind, right? It's a huge bringer of stress. So it's really important to work this out when you're not mad at each other and you're still in love. Work out who pays alimony, who keeps the retirement accounts. Prenups are a way to enter into a marriage with eyes wide open. And making these decisions when love is strong instead of when you're really pissed off at each other is a good idea. If you're already married, there's also the option of drafting a postnup. Of course, all of this takes money, and you'll need a lawyer for that. My husband and I actually just sat down and drafted a rudimentary postnup and sort of just talked about what we would do if we got divorced. This was prompted from a podcast, listening to a podcast, and we weren't actually having issues at the time, but it was a really good exercise for us because we basically sat down and wrote out what we would do with the rental properties and the retirement accounts and such, and it really gave me peace of mind to know that we've already worked out this, and hopefully we will stick to it if we ever do end up getting divorced. Of course, we hope for the best, but it's nice knowing that we already have this worked out, and it honestly gives me more trust in him, and him more trust in me, hopefully. The best layer of protection for your marriage, of course, is making the marriage last. Regularly scheduled date nights are key. We all get busy and out of touch with ourselves and our partners. It's so important to come back together and remember why you married the other person in the first place. Now that we have step 1 covered, take action and make sure you have these things in place. This shouldn't take longer than an evening. Reach out to one of our insurance broker partners like Set for Life, and they can do the heavy lifting for you on the insurance part. Now that you have protections for your family in place, let's move on to step 2. Save up a starter emergency fund. Josh had some health issues last year. He got into powerlifting when he was deployed to Afghanistan. Last year, he suddenly developed a ruptured chorda tendineae on his mitral valve after weightlifting. I heard the murmur. Let me tell you, that horrible murmur is the last thing you want to hear when you're sweetly resting your head on your husband's chest. He had to undergo mitral valve repair. After several months of not being able to lift the kids even, it was a tough year. But during that time, I basically took over the household chores, including doing the lawn. Never having mowed the lawn with a ride-on mower before, which I'm kind of ashamed to admit, that's something that Josh has always done. I, took to doing it when he was post-surgical, and I ran over the water shutoff valve located in the smack dab middle of the yard. Like, who does that? Anyway, the shutoff valve was like sticking up from the ground, and it was covered by leaves because it was fall. And anyway, I ran over it. So thank God that pipe wasn't actually connected to the rest of the pipes that went into the house. It was already broken. And we discovered this and had to fix it, but it was expensive. It was like $3,000 and having to dig that pipe out and then replace it. At the same time, can you believe it? At the same time, I smelled gas downstairs. I had been sort of smelling it off and on, but this was fall. So we were finally starting to use the heat. The gas smell became really strong in the basement. Turns out we had not one, but several gas leaks in the pipes downstairs in the basement. So all the pipes had to be replaced. And this is when my husband just had a huge open heart surgery. Talk about expensive. Of course, all of these things come at the worst time. Life happens. That's why we need a solid emergency fund. Thank God we didn't go into debt at this time. We certainly could have. But following these steps and having an emergency fund in place saved our butts and saved me a whole bunch of stress. Of course, it was already stressful, but thank God I didn't have to worry about our entire family's money situation going to heck because life happened. That's why we need emergency funds. When it rains, it pours. According to a study by Bankrate, 25% of Americans have to take on credit card debt for a $1,000 emergency expense. Don't let this statistic be you. Doctors can save up an emergency fund relatively quickly. An emergency fund is a pool of money that is there only for emergencies. Its job is not to go to work making you money for investments. Its job is to be there for you when life happens, so an emergency doesn't turn into long-term debt. It should be kept somewhere liquid where you can get at it within a day or two. How much of an emergency fund should you have? The traditional amount of an emergency fund is 3 to 6 months of essential monthly expenses. For most physicians, this will be somewhere between $20,000 and $50,000. While paying off debt, it's okay to have a leaner emergency fund. Dave Ramsey recommends at least $1,000 first before trying to pay off debt, and then building up to the 3 to 6 month emergency fund once all the debt is paid off. In the world of high deductible insurances, I think physicians should have at least $10,000 in an emergency fund, or the amount of our highest deductible, whichever one is higher. That way, if something happens, the stress of the emergency doesn't have to turn into financial stress and everlasting debt. I think it's okay to have a leaner emergency fund during debt payoff, because while we're paying off debt, we'll be living way below our means. So if an emergency happens that costs more than $10,000 that we have set aside, we can always put our regularly scheduled debt payoff on hold and put that extra monthly cash flow towards paying for the emergency. In essence, living frugally is an emergency fund in itself. This definitely happened for us when we were paying off our debt as well. We had a hurricane come through and flood our old Savannah house that we were trying to sell. So anyway, live through it. I can tell you that $10,000 is generally enough if you're already living frugally and you have that delta between your income and expenses. Once we're done paying off our toxic debt, we'll build this cushion up to 3 to 6 months of expenses to really build financial stability into our lives. All right, so we've gotten through step 1 and step 2. We're going to protect our family first, and step 2, save up a starter emergency fund. Next week, we'll go into the rest of the steps to get our financial house in order. But first, quote of the week. Estate planning is an important and everlasting gift you can give your family, and setting up a smooth inheritance isn't as hard as you might think. That's by Susie Orman. It is a huge gift if you can manage to give all of your assets that you're going to work so hard to build during your life. If you can give it to your kids in a smooth fashion without stress, that's a huge, humongous gift you can give to them. So yes, it's not that hard. It takes about an evening to get this stuff set up. Get that step 1 out of the way. Get the step 2 done. Especially with starting bonuses, physicians can save up $10,000 pretty fast. So step 1 and step 2 should be in your pocket relatively shortly. So next week, we'll go into step 3, and hopefully by then you have at least finished step 1 of protecting your family and making sure your estate plan is in place. A big thank you for our sponsor today, Set for Life Insurance. No matter what your insurance needs are, Set for Life Insurance has you covered. They're a nationally recognized leader in disability, life, and long-term care insurance, serving clients across all 50 states. Their dedicated team specializes in assisting medical residents, physicians, dentists, business owners, and other high-income professionals. That's all for today's episode of Finding Financial Freedom with the Frugal Physician. If you enjoyed the show, please be sure to subscribe and leave us a 5-star review on your favorite podcast platform. Your reviews mean a lot and help us get the word out. Actually, let me read one of the reviews that was left on the website right now. Here's a review from AM Higgs 17. I've been following Disha for a long time, and she and I have parallel stories. I love how down-to-earth and personable she is, and I'm so excited to listen to this podcast. So happy for her success. Thank you so much. It means so much to me that you've been following for a while, and I'm so glad that you're listening now. It's really so important that we all support each other, and thank you for being there for us and for spreading the word. If you have any suggestions, feedback, or questions, please feel free to reach out to me at thefrugalphysician@gmail.com, or you can go through the Contact Me button at thefrugalphysician.com. You can also message me on Twitter at Frugal Physician or on Facebook at The Frugal Physician. I also have a Facebook group called The Frugal Physicians. So come join our community. It's time to say goodbye, but fear not, my frugal-minded friends. Finding Financial Freedom with The Frugal Physician will be back with more inspiration, knowledge, and money magic. Remember, the journey to financial independence is a marathon, not a sprint. Stay committed to your goals, continue honing your frugal skills, and never forget the incredible power you possess to shape your own financial future. Together, we'll make waves in the world of healthcare and rewrite the rules of financial success. Thank you for all you do for your patients and your families, and for everyone around you. Until we meet again, keep embracing frugality and living your best life. See you later.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.